Welcome to Unit 5.5 Break-Even Analysis. This concept is crucial for businesses to determine the point at which they will start making a profit. In this unit, we will analyze and apply the concepts of total contribution versus contribution per unit. This will help us understand how each unit sold contributes to covering fixed costs and generating profit. Contribution is the amount of money a product contributes to covering the company's fixed costs and generating profit. It is calculated as the difference between sales revenue and variable costs. The contribution margin helps businesses understand how much money is available to cover fixed costs. Fixed costs are expenses that do not change with production levels, such as rent, salaries, and insurance. Once fixed costs are covered, the remaining contribution goes toward profit. Let's consider an example. If a store sells a bowl of soup for 35 Indonesian rupiahs and the variable costs are 15 Indonesian rupiahs, the contribution is 20 Indonesian rupiahs. This amount helps pay fixed costs and generate profit. Total contribution is the total sales amount earned by a company that exceeds the total variable cost. Unit contribution is the amount earned per unit that exceeds that unit's variable cost. Both are essential for understanding profitability. In this unit, we will analyze, apply, calculate, and construct various aspects of break-even analysis, including break-even quantity, profit or loss, margin of safety, target profit output, target profit, and target price. Financially, businesses operate at different levels: loss, profit, and break-even. Break-even occurs when the costs of production equal revenues, meaning no profit and no loss. The level of output where total costs equal total revenues is crucial for business planning. Break-even analysis informs managers whether it is financially worthwhile to produce a particular good or service and helps determine the level of profits if things go according to plan. At break-even, total costs equal total revenues. Suppose a jeans retailer has fixed costs of $2,500 per month, and each pair of jeans sells for $30 with variable costs of $10 per pair. To calculate the break-even point, we use the formula: fixed costs divided by contribution per unit. The contribution is the price minus the variable costs. In this case, the break-even point is 125 pairs of jeans. Any sales above the break-even point will generate profits, while sales below the break-even point will incur a loss. At break-even, total costs equal total revenues. Break-even is the position on the chart where total cost intersects total revenue. This point is crucial for understanding when a business will start making a profit. In this example, break-even occurs at 125 pairs of jeans. The total cost and total revenue intersect at this point, indicating the break-even point where the business neither makes a profit nor incurs a loss. The quantity of jeans sold above 125 pairs results in profit, while selling fewer than 125 pairs results in a loss. The profit and loss can be calculated by subtracting total costs from total revenues. The margin of safety is the difference between the current sales quantity and the quantity needed to break even. It shows how much demand exceeds the break-even quantity, providing a safety buffer for the firm. For a jeans retailer with fixed costs of $2,500, selling one pair for $30 with $10 in variable costs per pair, the break-even is 125 pairs. If the current demand is 200 pairs, the safety margin is 75 pairs, indicating the business can sell 75 pairs less and still avoid a loss. For business comparisons, it is better to express the safety margin as a percent. For example, if the safety margin is 75 pairs and the break-even is 125 pairs, the safety margin percentage is 60%. Let's practice calculating the safety margin. Tread It is a manufacturer of hiking shoes, and Play It produces wooden toys. We will calculate the missing figures for break-even quantity, output, and margin of safety for both businesses. The safety margin of Play It has more units, 300 to 250. However, the safety margin percentage is greater for Tread It, indicating Tread It is in a better position. To construct a break-even chart, calculate costs and revenues at the break-even point, determine a scale for the axes, label the axes, draw and label the total fixed cost and total revenue lines, and select an appropriate title. To determine the number of units needed to achieve a specific profit, we use break-even analysis. For instance, if Katia Jewels aims to make $3,000 in profit, we need to consider both fixed and variable costs. Katia Jewels sells handmade necklaces at $20 each, with variable costs of $8 per unit and fixed costs of $4,500. By calculating the profit formula, we find that 625 units need to be sold to reach the target profit. Let's break down the target profit calculation with an example. If Katia Jewels sells 625 units at $20 each, the total revenue would be $12,500. The total costs, including variable and fixed costs, amount to $9,500. Subtracting the total costs from the total revenue, we achieve the target profit of $3,000. To determine the target price, we need to identify fixed costs, which don't change with production volume, and variable costs per unit, which vary with production. Using the target price formula, we can calculate the break-even quantity. For example, with fixed costs of $5,000 and a selling price of $10 per unit, the break-even quantity is 834 units. In the IB curriculum, break-even analysis is crucial for understanding the effects of changes in prices or costs on break-even quantity, profit, and margin of safety. This analysis involves both graphical and quantitative methods to provide a comprehensive understanding. The break-even model is versatile and can be used to calculate various financial metrics such as quantities, prices, and profits. It also allows for what-if scenarios, helping businesses understand the impact of changes in fixed costs, variable costs, and prices. While break-even analysis is a valuable tool, it's important to evaluate its limitations as a decision-making tool. Understanding these limitations helps businesses make more informed decisions. Break-even analysis relies on certain assumptions that may not hold true in real business scenarios. For instance, it assumes linear costs and sales revenue, ignoring factors like economies of scale, customer discounts, and price discrimination. Another limitation is the assumption that only one product is produced and all output is sold. In reality, businesses often have unsold stock, which incurs additional costs and may be sold at a discount. Break-even analysis assumes costs remain static, which is only valid for a single point in time. It also overlooks various factors such as worker availability, capacity, and financial resources. The accuracy of predictions depends on the quality of the data used.